So we discussed the internal factors. What are the external factors that contributed to the slowdown, and how are other countries faring? The factors first: the US-China trade war, the rise in oil prices, the slowdown in consumption and the fall in demand. All these are serious factors causing havoc in many advanced economies. The World Bank has issued warnings, the IMF has issued warnings, even the International Energy Agency has issued warnings. In the US, growth fell to 2.1% in the second quarter of this year. That's a whopping 1% drop from the previous quarter. Exports are down thanks to the trade war. This has hurt manufacturing, it has impacted the dollar. So is a crisis inevitable? The opinion is divided. Some experts say that rate cuts from the Federal Reserve would help revive demand and investment. Unemployment figures are low. Even the World Bank predicts an economic revival in a few quarters. So it's not so gloomy for America. Let's talk about China, the second largest economy in the world. Growth figures are nothing to write home about. The GDP rate in the second quarter is the lowest in 27 years. Deflationary impacts are becoming visible, and China is playing with its currency, the yuan, to minimize the damage of the trade war. This will have ripple effects on the US economy. Years of high growth have papered over the cracks in the Chinese economy. With the trade war now, those cracks are beginning to show and beginning to widen. Elsewhere, Germany, the largest economy in Europe, is veering towards recession. In fact, it could become the first country to see a recession this time. Trade conflicts have destroyed Germany's export-dependent manufacturing sector. Brexit as a whole is threatening to disrupt not just the German economy, but the whole of Europe. And there are warning signs. Investors across the world are beginning to park their money in safe haven assets. China's slowdown means Brazil's exports are down. Argentina's meltdown means Latin American economy is in trouble. Even Singapore is tipped to face a recession in a few months. This is how connected the world is right now. And at this juncture, it is important to view India closely. India's economy is at a crossroads. It recovered quickly from the last recession, and it grew rapidly over the last 5 years. Now, with the global momentum falling, India looks relatively stable. External investments matter, but the Indian economy's fundamentals are dependent on domestic factors, and spending seems to be the immediate solution. In the last downturn, remember, China spent more and they posted strong growth. They're doing it again this time. India too needs to spend. The economy is resilient. The economy is relatively independent of global factors. It should be easier for India to bounce back.